All right, super. Well, hey, welcome everybody. This is Kurt Frankenberg, and let's get started. I wanted to talk to you today about how to put the odds in your favor using this structure, using this idea that I've been using now for 13 years, and now that folks from 38 countries all over the world, including Switzerland, apparently, are using now. All through 2015. Now we're almost halfway through it. Okay, I first put together this particular class at the beginning of the year, and here we are checking in at the midpoint. And I'd like to just reiterate the things that I've been talking about. How to, number one, structure your account so that you can't lose too much. And number two, after doing that, the winners seem to take care of themselves. Okay, so even if you're lousy at picking stocks, lousy at picking reading charts, you can still succeed in the stock market. That's me. That's a picture of me. This is Kurt Frankenberg. I'm broadcasting to you from Mission Coffee Roasters, my favorite place to down some coffee in Colorado Springs. And whenever I would see a new class or a new technique, a new idea, this question had to be at the front of my mind, and it needs to be at the front of yours. Okay, is this for me? Well, if it's important to you to protect yourself from loss when you're trading, if you think you'd like to know how to take income from stocks, maybe more than just the one or two ways that are popular, for example, dividend investing and using covered calls. If you'd like to know some other ways to do that, if you'd like to further participate in growth, you can do that with dividends, but with a covered call play, what you're doing in effect is agreeing for someone else to take a good winning stock off of your hands at their price, and you don't get to participate in the upward moves. You don't get to participate in the growth. Okay, so if that's important to you, I think this class will be for you. And then finally, how to essentially bulletproof your stock and no longer have risk, but still have upside potential. Now, I'm not going to say that that's always possible, but it is something that is doable, and we put ourselves in position to do it every time. Every time we put ourselves in position to do it, and when certain conditions happen, we're able to make ourselves bulletproof. And what that means is we begin at a place with very little risk, but after offsetting that risk with some income, we can get to a place where we have everywhere to go, all right, but down. We cannot lose, okay? And so that's what we call bulletproof. Now, again, I'm not making the claim that every stock can be bulletproof from the get-go. That's not the way it is, but it is something that's possible to do, and it's not a unicorn. It's not something that, hey, I heard about that once, but I've never really seen it. We've had thousands of people all over the world been able to plug into the system and then bulletproof their stocks, okay? All right, the blueprint is the name of my book. I will be giving a little promotion to that at the end, but this is not an hour-long commercial. We're going to be doing some real live examples and show you some real live stuff. In fact, a lot of folks have told me that they've picked up the blueprint out of their winnings after coming and taking a look at this system and applying it. Then they've been able to go and make some real money with it, okay? Or at the very least save themselves from disaster, right? If you got into a bad trade and you're following the principles of the blueprint, you can't possibly lose more than about 5% of what you had in that trade, even if the stock goes down 20, 30, 50%. Okay, we'll be talking about that a little bit later on. So the blueprint helps you reduce losses to 5% or less, regardless of what your stock does. Okay, and we're going to also be sharing income method number 5. There are 12 income methods in the blueprint. One of them is selling a covered call. One of them is does have to do with dividend trading. All right, but then what are the other 10? I'm going to go ahead and show you one of those today. I think you'll really dig it. Income method number 5 is a riskless spread trade. You heard that right. It is riskless in the context in which we perform it. Okay, this particular trade would not be riskless otherwise, but because of the context that we do it, there is no capital risk to doing that spread trade, and it may even pay you twice. It creates some income, but does not necessarily limit your upside growth potential the way that a covered call would. Okay? All right, so if you're still with me, okay, I'd like for you to say goodbye to the fear of pain and losses and say hello to trading confidently with a winning system, even if you stink at picking stocks, even if you can't read charts, and even if there's a catastrophe, something you totally can't control happens in the market. Okay? All right. Let's see. So what's the problem normally with our trading? All right. Normally I do a poll here. Maybe I'll take a look here and see what we've got set up here. Let me go ahead and do this. Okay. I'm just going to say, what statement best describes your performance over the last 12 months? Which statement from this list of 5 best describes your performance over the last 12 months? And we're not going to be, attaching any names to this. Okay, so don't feel embarrassed if you happen to lose last year, or if you happen to do some really good winning picks. We're not going to jump down your throat and say, okay, share them with me. Tell me. All right. So, what statement best describes your performance from last year? Okay, I haven't had everybody participate yet, so I'll leave that poll up there for just a few moments. All right, and then we'll give it another 10 seconds or so. I want to check in and make sure that questions are being handled properly. I'm not sure what has happened to my deal here. Hang on, folks. Huh. Yeah. Okay, that's the problem. I'm not viewing questions. Okay, now I've got questions. Okay, good. So I'm going to be jumping in and out, folks, and grabbing those questions. Thanks for participating in the poll. All right. So what is the problem with our trading? What is it that prevents us from all getting more winners than losers? Or what's the problem that prevents us from winning in the long run? Okay. It's the losses. All right. You could have 10 wins in a row and one loss that's devastating enough, and that loss can wipe out all the previous gains. All right, not cool. So losses certainly is something that we need to address. And believe it or not, this is the one thing that everyone has control over, and that almost nobody knows how to exercise that control. All right, not making enough money when we're right is an issue, but more important than that is losing too much when we're wrong. Now, folks, here's my background. Okay, I'm a martial art instructor. I've been teaching since 1986 in my own studio. It's done very well over the last 29 years. And I'll tell you what, the very first thing that I teach someone when they come into the program is how to keep up their guard, how to keep their hands up, how to not get hurt in the first place. That solves about 90% of the problems that they're ever going to face in the mixed martial arts cage or in the street, if they have to defend their life. Just being able to keep up your guard is the number one thing. Then the striking and the knees and the elbows and the headbutts and everything else, that sort of takes care of itself. But keeping yourself out of trouble, keeping yourself conscious is what's really important, okay? Now, rule number 1, as Warren Buffett says, is don't lose. All right, and then of course rule number 2 through 10 are refer back to rule number 1. Does Warren Buffett lose? Yes, he has lost, but he doesn't lose big when he does lose. All right, and he doesn't lose often. All right, so real quick background on me. I told you I was a martial art instructor, and was doing very successful with that kind of business up until the late 90s, when I was making 5 figures a month, teaching little kids and also grown-ups, how to get into the ring and box and kickbox, and or how to defend their lives and so forth. Having all kinds of fun with that aerobic kickboxing movement. God bless Billy Blanks. He with Taibo, he revolutionized 2 industries, both martial arts and fitness, and I was a part of that. Well, we were making 5 figures a month without even trying, and so I was looking for a place to put that money to invest. And I started out with real estate investing and found out pretty soon I really didn't dig that. It just wasn't my cup of tea. But then a fellow came along that was respected and known in the real estate investing world, and he began to teach about stock market investing. His name was Wade Cook, and he's the fellow that's probably most responsible, even though there's other folks now that have taken the ball and are running with it. He's the fellow that's most responsible for covered calls becoming a real phenomenon. Okay, lots and lots of investors now use covered calls to supplement their accounts. Okay, and this is what I was doing. I was buying stocks. I was selling the calls against them. I was getting called out. I was making money hand over fist in the late 90s. But as you probably know, everyone is a genius in a bull market. Okay, everyone's a genius in a bull market. Well, guess what? I wasn't such a genius. I thought I was. But I got cocky, and I did something that I never should have done, and that is to let down my guard. I bought a stock called LiPo, which no longer exists, okay, LIPO, and you might think it has something to do with liposuction. Now, LiPo means fat, and this was a company that was making a cancer-fighting drug that's delivered through fat cells. All right, I bought LiPo at $17 a share and was able to sell the $20 calls against those shares for $3 a premium. So if I get called out, all right, if I and forgive me, folks, if you're not familiar with covered calls, most folks are, but not everyone, and I know that. But what I've done here is given the obligation, or I've made an obligation to deliver shares of that stock at $20 a share, no matter what happens to it if it goes up. And $3 is what I was paid per share to hold them. Okay, to hold them for these speculators. And anyway, what I'm thinking is going to happen is that the stock is going to move up, and just like all the others did, right? I'm going to make a $3 profit on the movement of the stock from 17 to 20, and I've already been paid $3 premium to hold on to those shares. Well, guess what? There's a reason why folks will buy the call instead of buying the whole stock like I did. For $23, or $23 is what I'm going to get back, right, on a $17 investment, for per share. All right, and that's a 30% gain in 6 weeks. Okay, well, you can probably guess what happened. I'm thinking that I'm a genius. I've done pretty well so far with this strategy, and I sunk everything into this play. Moreover, I got into this play in margin. So guess what? One day, that stock opens up at $9 a share, starts going down from there. And I got a margin call from my broker. At the time I was using a full service broker. Now I do everything with mouse clicks. Okay, but back then I had a guy, right? And the guy called me and he says, "Kurt, they're asking for a margin call. What do you want to do?" And I said, "Well, what do you mean? What do I want to do? I'm sitting on the stock waiting for it to make me 30% in 6 weeks." He says, "No, you don't understand. The stock is down. You've borrowed money. A margin call means you need to come in with more money to even hold on to these shares of stock, or we're going to sell them for you." He says, "I'm sorry, but that's the rules. That's what I have to do." And what happened was I ended up losing all but about $400 of my entire life savings. Not only that, I had paid for this weekend covered calls trading seminar where they didn't teach me this. They didn't teach me that this could happen. All right. I invested while I was at the seminar, invested in some software. And also got a $100 a month subscription to their picks and their service. Well, following the course directions, I got cleaned up by the market, was almost bankrupt, got a divorce, and the divorce wasn't because of this. Okay, there were other issues, but it certainly didn't help, did it? Okay, so I got cleaned up by my ex-wife too, and had to start over. But I did what a good martial art instructor would do with one of his fellows that got hurt in the ring, okay, or not got hurt, but got beaten, okay. I looked at the fight tape. I said, okay, now where was it that the mistakes happened? Where was it that you, Kurt Frankenberg, could have done better? Rather than buying on margin, and rather than using just one strategy, the covered call strategy, if I had simply known one little tweak, this whole episode, if I had just known this one tweak, this whole episode would have turned into a profitable, money-wise experience. It was profitable in terms of, man, it made me decide to never let that happen to me again, right? But it wasn't profitable in terms of money. Well, guess what? It would have been profitable in terms of money if I had simply done this tweak. And almost by accident, I got handed this idea and this system that enabled me to do better. Once I embraced this fact that the big problem that got me into trouble in the first place was my own behavior, I learned how to reverse that behavior with practical strategies, and the practical strategy actually forced me not to risk too much of my capital. It forced me not to risk too much of my capital. Okay, and I became a winner in the stock market. In fact, I haven't had a losing year since. And this was, 2002 when I first put the capital back together to start trading again. Okay, all right, but listen, it's not about me, is it? You probably don't care if I'm doing well in the stock market or not. You care if you can do better than you're doing now. You probably want to know if I can help you with your success. And so that's what we're here about, okay? So why hasn't the problem been solved yet? Well, the problem of losses has been attacked from a lot of different angles, okay? On Tuesday, I did this exact webinar, okay? We were having some sound issues. We were having all kinds of problems with the presentation, but we did get through this little screen here, and one of them was I just have a feeling, and I found out that most of the people on the line, most of them were using this. They just were flying by the seat of their pants, okay? Buying stock or selling shorts and hoping for a good outcome. And this is what folks honestly shared with me, okay? Gut instinct is not the way to go. How about exit rules? There were some folks that wrote in. There's one fellow in particular that wrote in, and he says, I use stop orders and a scientific exit system. I said, oh, okay, scientific exit system and stop orders. All right, good. Well, you know, the problem with following a system is, first of all, following it. A lot of times we come up with a system, and then just at a crucial point, we decide maybe we'll bend the rules of our own system, do a little better. All right. That's one problem with that. The other problem with that is that even if you do follow your system, you do exercise discipline, you won't find out if it's a viable, real winning system until after you've risked money. Then it's just the nature of the game, okay? You can say you can back test and you can back trade and stuff and so forth, but really you can't actually test the viability of a system without trading real dollars in real time with your system the way that it is, okay? So stop loss orders, I haven't used a stop loss order in 13 years. And the reason for that is that a stop loss order is nothing more than a market order. And a market order is your way of saying to the market, bend me over and take advantage. do whatever it is that you want to do as far as the price that you want to give me for this, or the price that I'm going to have to pay for this. That's what a stop order is. That's what a market order is. And a stop loss order, if you've been using them, don't pretend you don't know what I'm talking about. If you've been using them, you know that very often you don't get filled at the exact place where you set that stop. Now this part's annoying. All right, this part's annoying. I joked with my broker, the fellow Mike that I told you about before. I joked with him that I had found a way to predict the exact low of a stock for the day. And he says, "Wow, how do you do that?" I said, "It's where I place my stop loss." So somehow or another that stock would come down, and I'd get that stop order would be filled, and then it'd go right back up, but it'd go up without me. Okay, so that's just plain annoying. But this is what's dangerous about a stop loss order. Stop does not mean stop at this price and sell at exactly this price. It means stop and sell at any price once the order's been triggered. And in the case of like an overnight gap, for example, here with Daktronics, all right, Daktronics lost 33% of its value overnight. And anybody with a stop loss order in place that wasn't there to, cancel it first thing in the morning, boy, they would have gotten hurt, okay? And take a look at this. Just a few months later, that stock is way up. Well, guess what? If you had played this my way, if you had played it radioactively, what I do is buy a put option that's far away in time. And with a drop like this, one of two things could happen. One thing is you could say, you know what? I'm just going to get out and I'm going to take my 5% loss. Yeah, 5% loss, not a 33% loss, okay? But a 5% loss. I'll take that. Or you could say, you know what? I think it might come back, so I'm going to hang out for a few months. And guess what? If you had done that, you'd have come out a winner in this play. All right? But a stop loss would have gotten you killed. All right. Finally, here's another way that folks try to combat. Well, I think this is actually not the final one. We got two or three more. But this is another way that folks try to combat it. They try fundamental analysis. And fundamental analysis assumes two things. Number one, it assumes that, number one, you are smarter than the rest of the market. Okay, the stock should be trading at this much, and right now it's only trading at this much, so it's a bargain. All right. And the second assumption is that the rest of the market at some time is going to get as smart as you are. They'll say, oh, you know what? You're right. It should be trading this high. All right, and then you're able to get out with your profit. Well, that didn't always work out. In fact, a company that's making money for itself may not make you money. The example that I like to use a lot is Apple Computer. In 2007, Apple Computer booked $3.5 billion of profit. In 2008, they booked $6 billion worth of profit. So that was a huge increase. And we're talking billions, not millions, but $1 billion, not revenue, profit. But in 2008, its stock price declined from $200 a share to $88 a share. That's a 56% loss. So Apple was real good at making money for itself. It wasn't good at making money for its shareholders. Fundamental analysis doesn't always work. All right, and technical analysis is a bold idea, isn't it? I mean, now please don't take insult. I know that many of you are chart readers, okay? But I'll tell you this, that some charts are really hard to read. And not only that, while you're in the middle of it, it's less clear than when you use hindsight, okay? This particular stock I did play. I played this particular stock, which had wild gyrations, but when I got in, I didn't have any possibility of coming out of it with with any more than a 5% loss. That was for the first 3 weeks. After the first 3 weeks, I was bulletproof. And what that means is I had offset the possible risk with a little bit of income. And when I offset that possible risk with a little bit of income, well, now there was no more risk. There was only upside. And so I ended up in 6 weeks taking out a 10.22% gain in this play. The 10% gain is not impressive in 6 weeks. What's impressive is that I could not have lost more than 5% for half of it, and for the other half of it, I was totally bulletproof. Could not lose anything. Okay, kind of cool. Now, another way that folks try to combat losses is diversification. But diversification doesn't work if the whole market is down. If you spread your assets over 35 different positions, then you have 35 different positions to manage. You may as well have bought a mutual fund. All right, and then finally, some folks try this, okay, and I'm going to recommend that you don't try insider trading, okay? Insider information will get you in trouble eventually, one way or the other, all right? And some folks that are famous for interior decorating might have to decorate something else, and so that's not a good solution, okay? Not in my book, okay? So, is the key to winning plays, is it picking stocks? I'm going to say no, okay? Because we all have made good picks and we've all made bad picks. We've all made bad picks that look good. Is the key timing trades? Well, not necessarily, okay? Not necessarily. Because if your timing is even just a little off on just one of your plays, it can eat into all of your previous wins, okay? But strangely, this is where everyone seems to look for the answers. They look for the answer in one or the other, or maybe even a combination of these categories: picking stocks, timing trades, right? What I'm going to do is teach you just real quick how the radioactive profit machine works. All right, the radioactive profit machine, or RPM, skews your reward over risk. It skews what's called expectancy. Now, if you don't know what expectancy is, it's what Vegas uses all the time. Their expectancy, for example, at a particular game might be 1.03. And what that means is that for every dollar that's wagered there, they're going to make 3 cents. Every dollar that's wagered there, they're going to make 3 cents. Now, does it happen all at once? No. Okay, because I mean, obviously, if every single time I play, as the player, I play $1 and I get 97 cents back, okay, if every single time that happens, I'm going to obviously not want to play. Okay, but they hold that promise out there that, hey, sometimes you're going to have a big win. So my $1 might bring me $400, every once in a very great while. Okay, and so that's the temptation. Well, here's the thing. The expectancy is skewed in the favor of the house, and the expectancy is a function of both probability and parameters, okay? Now, here's the quick overview of how the radioactive profit machine works to skew the odds in your favor. If you're concerned about your stock losing value, okay, here we have the dotted line as your cost basis, and if the stock goes up, it goes up, but if it goes down, you could lose everything. I mean, theoretically, you could lose it all right? Okay, so the solution that I had been using was the covered call solution. Covered calls, what happens is you buy the stock, yes, you take on that risk, yes, but then you have the privilege of selling one of those calls. Okay, you sell somebody else the right to buy your stock at a higher price, okay, and they give you money for that. It's kind of cool, all right? And what happens is you've paid for your stock, all right, and then it could go up or down, of course, but then you lower your cost basis by the amount of the premium that you captured. Okay, so instead of up there, now it's down here. It's not a big move, but it's a move, right? So instead of losing everything, you can lose almost everything. Now, that doesn't sound very good the way that I put it, does it? Here's something that's even worse. If your stock goes up, guess what the price is that you've paid? For accepting that premium on the front end, you have traded your ability to participate in the upside. And a lot of folks that have done covered calls have found out that it's a sorting machine. It sorts winning stocks out of your account and leaves you with the losers. Now, just to illustrate my point here, just before we show you the structure of the radioactive profit machine, I'd like to ask if we've got some folks here that have been trading covered calls consistently for a long period of time. And I don't know if there even is, okay? So I'll just leave this poll up here and see if I get any performance, okay? If I get any participation, okay? How are your covered calls trades performing? Now, 3% per month for 24 months is doubling your money over a 24-month period. 6% per month for 24 months is quadrupling your money over a 24-month period. And 3 to 6% is what they promised us, okay? If you, like I, went to one of these weekend seminars, okay? Now, if you've fallen short of that performance, go ahead and let me know, okay? If you're ahead but not like what you were promised, or if you're about flat, or, hey, even if you're losing money, let me know. Now, again, I don't know if anybody's going to be able to participate. Oh, look, it looks like we did get some votes. Okay, we did get some votes. Now, what we were promised, what I was promised, and what almost everybody was promised that went to one of these covered call seminars is that, hey, you're going to be able to get 3% per month and compound it. Well, 3% per month over 24 months is doubling your money. You're going to get 3 to 6%. So 6%, the upper end of that spectrum, would be quadrupling your money over a 24-month period because of the compounding. Okay, folks, I think we've got all of our participants in, and guess what everybody said? Everybody said, no, didn't make the 3 to 6%. You didn't make the 3 to 6%. You're ahead, right? But not like what they promised. Okay, so I don't know that this is necessarily the best solution, and I'm going to go ahead and assert that it really isn't. Okay, let's take a look at the radioactive profit machine. The radioactive profit machine begins with ownership of stock, but now instead of the sexy idea of collecting a little bit of premium and lowering our cost basis, what we're going to do is we're going to actually add a small amount to our cost basis. And so we're going to buy stock insurance. That's what it is. Okay, we're buying a put option. And we're going to do it in a very particular way. Most folks have learned about a married put. Okay, I'm not here to tell you about married puts. I'm here to tell you about a structure that's a very specific, I almost said Pacific, a very specific kind of married put. So we're going to pay a little bit of insurance, and we're going to raise the cost basis of our stock, sure. But now we can't lose too much, okay? On the other hand, our upside, while it has been lowered a little bit by the purchase of the put, it still remains unlimited to the upside, okay? And folks, I've bought into Priceline. I made a 40% gain, not just on the stock, but on the stock and the put. I've bought into Amazon and seen an over 100% gain. Bought into, I already said Priceline, didn't I? SunTech Power, a more speculative stock, and made 40%. You know, Marvel, the comic book company, and made 30% in 2 months. Okay, and the thing is, you can make big returns. I'm not saying that you always do, but you can make big returns when you have stock insurance. Would those returns be possible if you had a covered call in place? Not a chance. Not a chance. If you bought Marvel just before Disney made the announcement that they were purchasing Marvel for $4.4 billion, and you had sold a covered call, guess what? You'd make your 3%. All right. You'd make your 3% that month, and that would be it. Okay, instead of 30%. All right, so here's the idea, okay? We want to leave our upside open, but cut down on our downside, and this is what adds skew and changes the expectancy equation. What happens is, rather than expecting to lose a little bit every time you play, you can expect to win a little bit every time you play. Even though sometimes you will lose, over the long haul, you're going to win, okay? Here's the deal. Here's your stock cost basis, and if you've got a stock, every stock has its own volatility signature. Okay, Netflix is going to be different than GE, for example. All right, but let's say you've got a stock that could vary by 15% to the upside or 15% to the downside. Maybe there's an earnings announcement coming up, and geez, research in motion used to fluctuate by like 30-40%, okay? But here's the deal. You're going to insert a put option. By getting a put option to limit how much you can lose, yeah, you're going to cost yourself a little bit. If the stock would normally go up 15, well, you've spent some money on that put option, and so now you're going to only make 10, okay? On the other hand, if the stock goes down, instead of losing 15%, you would only lose 5. Okay, so playing like this, where you're risking nickels, but you're making dimes, well, you could actually even afford to be wrong most of the time, and you could still make money. You could be wrong more often than right and still make money, and that's the essence of the radioactive profit machine. Okay, so now, if there's no questions, I'm going to run into the practicals on this. I think a lot of folks would like to see the practical application. Carl says he wants to see the practical application. Very good. Okay, so here's what we want to see. The radioactive profit machine is where you purchase stock. Okay, I'm showing a dated example. This is from about a year ago. Okay, you're purchasing stock, but along with the stock, you're also buying a far away in time in the money put option. Now, there's a reason for doing this, okay? And a lot of folks will look at that. They'll look at the $58.95 and they'll say, you can't make a dime until the stock is at $59 a share, because everybody knows that as the stock goes up, the put comes down. Well, that may be true, but when it's far away in time, and particularly when it's far away in time and slightly in the money, it doesn't behave the way that you would expect. For example, if the stock did go to $59 a share, you wouldn't make a nickel. You'd make almost $10 on the stock, and your put would decline by, $2 or $3 or $4. Why? Because the stock is, the put is so far away in time, and it just behaves differently. We're going to see that here in a chart here in just a moment. But the point is this: the stock does not need to go to $58.90, $59, okay, for you to make a nickel. In fact, the stock needs to only go up about 10 cents for you to make a nickel. Okay, if it goes up 15 cents, you'll make a dime. It's a lot different than you might expect. And by the way, I don't expect to hold this all the way till January. I want to do some plays in the in-between time. We're going to talk about that in a moment. Here's our total invested amount, but because we have a total invested amount of $58.95 and we're guaranteed $55 back, the difference is all that we're risking. And remember, I told you earlier, keeping your hands up is the most important part of a fight. Okay, you keep yourself from getting injured, you keep yourself from getting hurt too badly, then the winning is going to take care of itself. The total at-risk amount here is $3.95 or $3.95 out of $58.95 invested. So that's really only 6.7%, and when you think about it, really, it's not 6.7, it's more like 5-ish%. If you get out early, you see this red line? This is halfway to expiration. The blue line is expiration. The red line is halfway to expiration. Well, whether you're winning or losing, whether the stock is going up or coming down, if you get out early, you get out on this red line, right? And so you'll make more or you'll lose less. Okay, and the losing less, this number here could be more like 4%, 5%. Okay, all right, now I am going to show you how to take advantage of this upside. Now I'm also going to show you how to erase all this risk. We've got risk here. I'm going to show you how to erase even that, but we do start out with some risk. Okay, but before we do that, I want to just do a real quick poll. Okay, think about what I just showed you. If every loss that you took last year was reduced from whatever it was to 5% or less, would you have had a better year? Just real honestly. Real honestly, think about what I just showed you. If you did not take any loss greater than 5% last year, would you have done better? Okay, now somebody answered yes. Buck, thank you. I'm looking for your answer on the poll. Okay, so I sent out a poll also. So Buck, thanks for answering on the question pod too. Very good. And the reason I'm doing this is because this is what I want to share with everybody. Okay, good. I think Buck jumped in there. All right. Yeah, we got a neck and neck tie going on here. Look at this. This is amazing. I'm going to leave this up for about another 5 seconds. So if you haven't had a chance to vote, please hit that. Think about what I just showed you. If you didn't take any losses of greater than 5% last year, would it have been a better year? Okay, and close. All right, so, and then it ended up at exactly 50%. Okay, 50% said, yeah, I would have traded better. I may have lost last year, but I would not have lost as much. So is that a better place to be? Yes. Okay. And then another 50% said, you know what? I did well last year. But now that I think about it, I would have done better with this. I would have done better if I had simply stemmed my losses, if I never took a loss greater than 5%. Well, I'm going to show you a good friend of mine that never took a loss of greater than 5% in a full year. But during that same year, he also did pretty well. All right, let me go ahead and let me hide this poll. And we'll show where this goes from here, okay? All right, so 395 is all that we have at risk, even if we hold all the way until expiration, even if the market crashes, all right, and even if we close our eyes and don't do any kind of adjustments, all right, and we are going to do adjustments. But if we didn't, okay, guess what? This is how much is at risk, $3.95. Okay, so here's the question. Why do you spend so much on that put option? Well, what kind of insurance would you like to have? You know, if you're trying to insure your car or your home, would you like to have the bare bones minimum? How about if it's health insurance for your granddaughter or your daughter? I have both. Okay. What if I mean, do we want to skimp? Is what I'm saying. No, we want to probably get the best insurance that we can get, right? And guess what? Insurance is used in every category of our financial life except when we invest. Isn't that crazy? That's crazy. That's stupid. You know, any of you that's a homeowner, most of you are homeowners, I'm sure. Would you live in a home that couldn't be insured? You know, would you be able to obtain a mortgage from a mortgage company without insurance for your home? No way. No way. Okay. And so here's the deal. It's not about whether or not you should be insured. It's how you're going to insure yourself. Well, a lot of folks look at my faraway put option and they say, well, the further out you buy, the more expensive it is. Well, yes and no. More expensive it is total, but the less expensive it is per day. Also, I don't have any intention of holding it all the way till expiration. So here's the phenomenon. The phenomenon is that time value falls off slowly at first. Let's say I only want to stay in this position for 30 days. If I buy a put option that's 30 days away, I will definitely lose all of my time value as that expiration Friday approaches. I'll lose it all. Okay. On the other hand, if I want to hold it for 30 days, why can't I buy a put option that's 4 months out and then sell it when it's 3 months out? There's no reason I can't do that, right? Yeah. So what I've done here is made it so that I'm protected for a 30-day period, but I'm spending a teeny amount. This teeny amount of decay is what I am paying for the protection. Okay. Now, most folks would do it the other way around. Most folks would pay a lot for their protection and maybe not get as good protection because they go what we say out of the money. You know, you got a stock that's trading at $50, and so you buy a $45 put. No, I want to buy a $55 put. That's what we did in our example. Why? Because we're going to lose less, okay, if the stock goes down, and we'll make more if it goes up. How about that? It just makes sense, okay? Now, we've already done this poll. I said to confirm the truth of what I'm saying, think back to your record. Would the RadioActive Profit Machine change it? And this is what was told to me today, okay? We've had different numbers on different days, but today 50% said, yeah, you know what, I may have lost last year, but I would have lost less. And then 50% more said, yeah, I did well last year, but I would have done better. Okay, that's even with the same picks and the same timing. So it isn't about stock picking, is it? It isn't about timing trades, is it? Success in the stock market is about skew. It's about losing less when you're wrong and making more when you're right. Okay? Well, I've shown you how to lose less when you're wrong. Let's do the making more than making more when you're right part. Okay? Kind of cool. What's so different now? We've added skew. We've done skew. That trader's maxim of cut losers short and let your winners run is actually being put to use, right? Okay. And now we're going to talk about expectancy. Taking the average number, total number of your wins, and you multiply it times your average win. That's one side of the equation. And then you subtract your number of losses multiplied by the average amount of the loss. It's the other side of the equation. And this will give you expectancy, and expectancy should be greater than the numeral 1. If it's 1.12, then you can expect over time that for every dollar that you put into your trading, you'll get 12 cents back. Okay? If your expectancy is 1.12. Now, it doesn't happen every trade. It's what happens over, a profile of trades or a lifetime of trades. Okay? Not necessarily your whole lifetime, you understand? Like a lifetime might be a year of trading. Okay, so during this year of trading, guess what? If your number of wins times your average win minus your number of losses times your average loss is greater than 1, you will expect to win in the long run. So let's talk about my good friend Mike. You probably answered the email today, or you probably opened the email today that talked a bit about Mike. Mike is the Director of Options Education over at Power Options, and he introduced me to Ernie Zarenner, the founder of Power Options, back in 2007. Now, let me help you understand something. I'm not an employee of Power Options. I don't work for them, but they are a wonderful company, and I was a customer at the time, and then later on I became sort of partners. We will do promotions for each other because guess what? We have similar ideals. Now, Mike had some trouble with his options trading. He'd been impacted by losses. He had done covered calls trades. He had done condors and butterflies and, any number of exotic kinds of trades, including calendar calls, where you buy a call that's far away in time and you sell near-term calls against it. Okay, so this was what Mike had been doing, and he had been doing well, but his losses impacted his wins so that he was actually behind the curve. Okay, he was actually losing money. When I say doing well, he's doing better than most options traders. Okay, but once he became familiar with this idea of changing expectancy, it wasn't that his system for picking stocks improved, and it wasn't that his system for timing stocks necessarily improved, but he turned a losing record into a winning one. In 2008, he did lose money. He lost 1.5% of his capital, even though he was using 100% of his capital in stock. Now that's saying something, because in 2008, most of us that were trading know what happened, right? It was a bad scene. It was a really bad year. Okay, and he was long stock, meaning he wasn't doing shorts. Okay, he was long stock this whole time, and posted a 1.5% loss for that year. Why? Because of using the income methods to offset the cost of puts, and then using puts to insure stock. And when you lose 1.5% of your capital, what it means is you've got 98.5% of it left when the bottom of the market rolls around in March 2009, and he's still investing in long stock. Well, I probably don't have to tell you, but I'll go ahead and tell you that he's had double-digit gains every year since. All right. He did struggle with options at first, but now that he's gotten control, he's had 6 years of double-digit gains: 2009, 10, 2011, 2012, 2013, 2014, and he's on track for 2015 being double-digit gains. Okay. Now, I saw a couple of questions come in, so let me just hit those real fast. Okay, hang on. Syed asks, how do you correct a losing position in a covered call and a long call? Syed, I don't know if that's a question for this forum. How do you correct a losing position in a covered call and a long call? The best way to correct a losing position is to insure against it losing in the first place. Okay, before you do a covered call, you want to buy a put option that protects you. And if it's already happened, I'm afraid it's too late. The good news is that you probably didn't have as big and as deep a cut as I did. You probably didn't have as big a loss as I did before I had to realize this. Okay, so from here forward, I would say insure yourself. All right, so good question from Syed. So this is Mike. Mike is talking about his SLW. Okay, SLW is silver wheaton. It's a mining stock, kind of speculative. All right, a little bit volatile. My SLW position, says Mike, was 300 shares plus 3 put options. Okay. I had only single-digit risk at the beginning, but then I used an income method to become bulletproof in the first 5 weeks. So at the very beginning, Mike had bought stock and he also bought a put option, and the condition is this: if the stock goes down, he could lose, 5-6%. All right, but during those first 5 weeks, he also used an income method to generate some income, and he offset the cost of the put enough that now his cost basis for the stock and the put option is less than the strike price of the put. In other words, he's bulletproof. If the stock goes down, he can't lose. If the stock goes up, he can win. So what happened? Well, what happened is that the stock and put options went on to make 58.9. The amount that Mike invested in both stock and puts was the amount that we're computing this from, okay? So it's as conservative as it can be. The puts went down. All right, but 58.9% on your money is not bad any way you slice it. Okay, so if we're going to talk about Mike's winners, let's also talk about his losers. In the same 12-month period, Mike invested a similar amount of money in a similarly speculative stock. He got into Talisman Energy. He says, I also picked another winner, okay, Talisman Energy. Now, guess what? Talisman Energy stock lost 50% of its value while Mike was in it. But the good news is this. Mike's loss was 4.5%. He started out with single-digit risk, just like we talked about. He even brought in a little bit of income, but it wasn't enough to offset his risk completely. So he didn't bulletproof himself. But guess what? 4.5% was the biggest loss that he took in that entire 12-month period. And that's out of, not 2 trades, okay? That's out of like hundreds of trades, at least several dozen, okay? At least several dozen. I think he probably traded over 100 times that year. But if the biggest loss that you take is 4.5%, right? And you've got some winners in there, some of them, in the high double digits, you're going to do very well. When you have 50% loss, think of this. If you have 50% losses and 100% gains, you'd never get ahead. Why? Because you'd cut your money in half, then you double it. Then you cut it in half, then you double it. You cut it in half, and you double it. All right? Unless you're right significantly more often, okay, then that could work. All right? But, here's the thing. When your losses are only 4.5% and your wins are, more, you're going to do better. In Mike's case, guess what? He was able to control this part of the equation. And that's the part of the equation that I'm offering you control over. The average loss. Okay? Your number of wins times your average win, I have nothing to do with. Okay? I don't know. I don't know what you're going to do with it. Okay? How many times you'll lose, how often you'll pick losers, I have no idea. But I can tell you this. I can help you control this portion right here. And this portion right here is the only thing you can control. And it's also the only thing that really determines your success or failure. So I'm offering you success, all right? In short, I'm offering you success. Your average loss. If you cut your average losses down, it's just like a mixed martial artist. If the other guy just can't damage him, well, the win is going to take care of itself. Okay? All right. So expectancy. Mike was able to take his expectancy and raise it. So that's what's different now. But what else is different now? What else is different now is that there's also these income methods that I've been talking about. Okay, within the context of the radioactive profit machine, you can generate income 12 different ways. And you can think of 2 right off the top of your head, I'm sure. You can think of, hey, if I did this with a dividend-yielding stock, the dividends might offset the cost of the put after time. Well, guess what? Yeah. In fact, I've got an anesthesiologist in Georgia that's his main strategy. His main thing that he does is invest in dividend-yielding stocks, and he also buys put options. And he buys those put options far away in time and expects the dividends to counter the cost of his puts. Well, guess what? After a certain time they do, but if the stock goes up, hey, that's gravy. If the stock goes down, no big loss or no loss, right? Either no big loss or no loss. If the stock goes up, he does well. Here's another one that you can think of. You probably think of selling a covered call, but be careful because a lot of times folks will sell a covered call at a really stupid level. You do not want to sell a call at a strike price that's lower than the strike price of your put that's protecting you. All right. Now there's some reasons why not to do this, and I go into them in my book. All right. I do want to keep you out of trouble. Okay. But if you're thinking, hey, you know, I went to this seminar, this webinar, Kurt told me that I need to insure myself, so I'm going to buy stock and I'm going to buy a put option, and oh, by the way, I'm going to also sell calls. Hey, you know what? Hold up there, Sparky. You're going to want to take a look at, you know, what my 13 years of experience doing this has taught. Okay. There's 12 different ways to generate income. In fact, some of them will have nothing to do with short calls at all. They may have something to do with manipulating your put options. Okay, so anyway, here's the income methods. What I'm going to do is I'm going to share one income method here today, one of the 12. Okay, using the income methods, you reduce risk, or you take income, or you do both. And the idea of skew, okay, we've got some skew here where if the stock goes down, we can't get hurt too bad, but if the stock goes up, we do very well, right? But we're going to enhance that skew by lowering our cost basis, and when we lower our cost basis, we still leave the upside open, okay? And that's kind of the idea here, okay? All right, so Mike, in the context of buying this stock and also buying a put option that was clear out to January of the next year, in April, what he does is this, April 21st, he sells to open 2 May $55 call options and simultaneously buys to open 1 May $52.50 call. Well, this play here is called a ratio call spread, all right? But we call it income method number 5 because we're not just going to do this spread. If we were to just do this spread, it would have infinite risk. Infinite risk. You see, the premium captured by doing this is 40 cents, okay? And 40 cents is received, but if CAR goes above 55.40, then we start losing money. We start losing money normally. Okay, that's what would happen if you just did this play here called the ratio call spread. Okay, and here's the outline or the graph of that. All right, the green line is the present price of the stock. If you're doing this when the stock is here, if the stock stays where it is or goes down or even goes a little tiny bit up, you're going to keep your 40 cents. If the stock goes up a little bit more, guess what? There's going to be a little bump here where you can actually get paid a second time. But, and this is a big but, okay? And I don't like big buts, and I cannot lie. Here's what happens. If the stock goes way up, what happens is we have unlimited risk to the upside normally. Okay, we have unlimited risk to the upside. And the reason for that is we've sold 2 calls and bought 1. We have a naked call in place. Some brokers won't even allow you to do this unless you have a very high trading clearance. And you certainly can't do this in the context of an IRA, for example. Okay? All right. But what I'm going to show you is that you can do this in the context of your married put. Here's the deal. The risk that's inherent in this, all this red water down here, the risk that's inherent there is the risk of having to deliver 200 shares at $55 and only being able to buy 100 shares at $52.50, right? The other 100 shares, you've got to go out on the open market. Maybe it's trading at $60 a share. You've got to buy it at 60 and deliver it at 55. Well, does this risk go away if you already own the stock? Yeah, it does. Remember I told you I was going to show you a riskless spread trade, and it's riskless because of the context. Well, guess what? This spread trade normally has all kinds of risk, all right? But if you already own the stock, now there's zero risk to doing this play. You're going to collect 40 cents, and that's the worst thing that could happen. The best thing that could happen is that you'll make more than 40 cents, and let's see how it turned out for Mike. Okay, Mike got his 40 cents, and when May expiration came, remember, Mike has still got 100 shares of CAR, Okay, Avis budget rental stock. He's got 100 shares of that. He's also got a put option protecting it, clear out till January of the next year. Okay, and in May, Mike decided, hey, I want to keep my CAR. Now, what would you have to do normally if you were short, if you had sold a call and the call went up above $55 a share? You'd have to buy to close the call, right? If you want to keep your stock, you'd have to buy to close your call. Well, that's what he had to do. He had to unwind this trade. What Mike did in the daytime on expiration Friday was he bought to close those two May $55 calls because the stock was trading between $54 and change, and at the end of the day closed at $55.16. Well, during the day, while it was bouncing around, he placed a limit order. He says, I want at least $2, and he got more than $2. What he got was he bought these two for 15 cents and sold this for $2.35. Now, this May 5250 call, if you'll recall, he owns for free. You know, he got paid to own it. In the previous screen, let's see it again. In the previous screen, he sold two calls, got $3, used some of that to buy one call, and so he's been paid 40 cents to have this position, and now he's being paid $2.05 to unwind this position. So that's a total of 40 cents to get in, $2.05 to get out. That's $2.45. Now, what if he had just done a plain vanilla covered call? What if he had sold a call for $1.50, right? Go back again. $1.50 on April 21st. If he just sold one May $55 call, well, he'd get $1.50 for it, right? And if you want to keep a stock, then he'd still have to pay that 15 cents. So that would be $1.35. So this is a lot better than a cover call play, wouldn't you say? $2.45 premium instead of $1.35 premium. How about them apples? I'm going to ask you, what do you think of that? Okay, what do you think of that income method that I just showed you? First of all, it's a riskless spread trade. You can vote more than one category, by the way, here. First of all, it's a riskless spread trade. It's riskless because of the context in which we did the trade. We already own the stock. Owning the stock takes away all the risk. Okay? All right. Oh, maybe I'm wrong. Maybe you can't vote more than one category. I think you can only pick one. So pick your favorite. That was wild. I didn't know you could do a riskless spread. Or this one trade made it worth all the time I spent here today. Or I want to know more about riskless spreads like this. Or can I do what you just showed in an IRA? I'll go ahead and answer that one. You can do what I just showed you in an IRA if the custodian will allow it. Okay, there are some custodians that will allow it. There are some custodians that will not. But as far as the legality of it, is it legal to do this in an IRA? Yes, it is legal. And by custodian, what I mean is your broker. Okay, if you have Scottrade, they probably won't let you do this. Okay, you got Schwab. I'm not sure. Have to check on the rules here recently. Interactive Brokers will let you do it. Options Express will let you do it. Thinkorswim. Okay, let me go ahead and close that poll. We got a four-way tie here. I didn't know you could do a riskless spread. This one trade made it worth all the time I spent today. I want to know more about riskless spreads like this, and can I do what you just showed in IRA? And I answered that. Okay, cool. Okay, so here's the deal. If you'll recall, this was Mike's CAR position where he had a stock plus a put option far away in time. And the red water here represents how much he could lose, which you might recall was $3.95. He bought stock at $49 and change, and he bought a put option. Okay, and the difference between the strike price of 55 and the invested price of 58.95 was $3.95. Okay, so this is how much he could lose, but then he just collected $2.45. Well, what happens to his risk? You see, at that point, the stock plus put structure reverts to this, right? The calls are all out of the picture, all right? And, Mike did another income method afterwards and became what we call bulletproof. He made it so that he had reduced the cost basis of his stock plus his put less than $55, and yet he owns a $55 put plus the stock. Kind of cool. Okay, so Mike did end up with, I think, a double-digit return. I know that he did do very well with this stock, but the really exciting part was, CAR did go down at one point. It experienced a serious tumble, but he didn't have to really participate in that tumble. In fact, I think he may have collected dividends. If it's a dividend-yielding stock, I know he held this for a pretty goodly period of time, so he may have collected dividends once or even twice. Kind of cool. So income method number 5 is the ratio call spread, but it's a ratio call spread done in the context of your radioactive profit machine. When you do this in the context of owning stock, the risk of having to deliver stock goes away because you got it, right? Okay. Now again, you may not get all this on your first viewing, and I really would caution you against just leaving this webinar and saying, okay, I got it. I'm going to buy calls, sell to against. I'm going to buy stock and buy a put, and I'll figure it out. No, there are certain parameters. There are certain parameters that work, and there's others that don't work. Okay, and when they don't work, you just don't do it. Okay. All right. So doing this ratio call spread in the context of your RPM generates credit, and sometimes it can generate a really big credit. In this case, it was 80% more than you could get out of a pretty healthy covered call. 80% more than you could get out of a really healthy covered call, okay? But without any of the capital risk that goes along with the ratio call spread. You apply the income methods to lower your risk or your cost basis, or both. And if you do this with the right savvy, you can end up with a married put, a stock plus put combination with all of your time value paid for, but your upside left intact. And that's what we call bulletproof. And it's a really exciting place to be, especially when earnings come around. When earnings come around, can you imagine going into an earnings announcement with all the anticipation and excitement of, hey, what if it's a really good announcement? Right? But none of the fear and dread of what if the market reacts negatively, okay? So, all right, so I already gave this reminder. You may not get all this in the first viewing. That's why I would say pick up the blueprint, use your support, all right? Write us at support@radioactivetrading.com before you get into any radioactive position. This is what I caution all the time because I do want folks to really fully understand what they're doing. If we're going to skew ourselves, we don't want to screw ourselves. All right, we're gonna skew our expectation to where if our stock wins, fine, okay. But if it doesn't win, we don't get hurt, and eventually it's possible to reduce that gap to less than zero, and that's what we call bulletproofing. That's a really, really happy place to be. Okay, folks, I'm going to take a couple of questions, and while I'm taking some questions, I'll run through this. What to do next. Okay, what should you do next after this primer on limiting losses and bulletproofing stocks? Okay, let's see here. Hang on. I already did this. I said, think about what I just showed you. If you kept your losses down last year, would it have been a better year? Okay, and everybody said yes. Everybody that participated anyway said yes. Okay, so I'm going to say how much. How much better off would you be? Okay, if you simply use the setup that keeps you out of trouble to where you never lose more than 5% in any one play, kind of like Mike, in the same year where he picked up the 58.9% gain, his biggest loss for the whole year was 4.5%. All right, if you could do that, how much better off would you have been last year? Okay, how much better off would you have been last year? I'll leave that pull up for a few seconds while folks are thinking, and I can check in with the questions. If y'all have any questions about the blueprint or about the strategies, please forward them in. Okay, we've got some good votes already. How about that? It's split between two again. I'll leave that bullet for another 3 seconds, 2 seconds, 1 second. And she's still split. Okay, let me share that. Pardon me, got hiccups. Okay, so 50% that voted said I would have saved or made enough to be ahead by $500, and another 50% said this would have made at least a $5,000 difference. A $5,000 difference. Wow. Okay. Let's see. I got a half a question from Jan. It says, "Can you STE?" I'm not sure what that means, Jan. Did you want to take a look at a stock called STE? Looking for Jan's question. I got half of your question, Jan. I'm not sure what may have happened. Maybe some of it got clipped off in the as you're sending it. Okay. While Jan is thinking about that, let me take us through what we should do next. Okay. All right. So the bulletproofing, the idea of keeping yourself out of trouble, but at the same time having the opportunity to take advantage of the upside, it's really tempting. Okay. I'd like for you to do this. Number one, take a look back at your trading record, which we just did. Would the radioactive profit machine change it? Now, everybody that participated in the poll said yes. Okay. Even with the same picks and same timing, you could have done better if you had no losses greater than 5%. Some folks said, I may have lost last year, but I would have lost less. And some folks said, I did well last year, but I would have done even better. So everyone would have been in a better place. Okay. All right. Number two, consider how different things might be if you also were able to take income. Okay. Did covered calls limit your upside? Well, when we did this poll here, we found out that nobody's making 3% per month. Let me pull that. Okay. How are your covered calls performing? This is what everybody said. Everybody said, I'm ahead with my covered call plays, but not like I was promised. Okay. So nobody was taking that 3% per month income. Okay, fair enough. All right. So would you like to, for example, if you had known this last year, you would have gotten 80% more, right? I showed an income method today that would get you 80% more premium than a plain vanilla covered call might. Okay, so that's an idea. All right. So if there are any instances in which you could have gotten a better return, consider that. Okay. All right. So let's examine the value of the blueprint at radioactivetrading.com. Some of you said that the feature of never risking more than 5% would have meant $500 more to you last year. And let's ask this. Do you expect to trade for another 10 years or more? Well, then that's $5,000. Okay. And some other folks said that it was a $5,000 difference last year. So if you expect to trade for 10 years or more, then that would be a $50,000 difference. But I'm not going to charge $50,000 for the blueprint. I wouldn't be able to sleep at night. Not even $5,000 because you know what? I could sleep at night with that. I could. I believe that this information is certainly worth it. Okay. All right, Jan, I do see your question. I'll hit it. Okay. Here's what I want to mention is that the blueprint is more like $600 when you get the deluxe version. I mean, when you get all the bells and whistles that we have to offer, it's $600. Okay, and you can even get by with a smaller amount. If all you want to do is just read the blueprint, it's $339, and the blueprint is not just a book of pages and ink. Okay, it's a book that includes the support of two offices, the Colorado Springs office and also the New England office. Okay, and so if you pick up the blueprint at $339, you'll have the support of both offices. The $600, that's the home study kit. The home study kit has not just the blueprint, but also 6 CDs, which are audio-visual presentations that reinforce all the concepts that are in the blueprint. If you want to go big, then it's $600. Okay. And if you want to pick up just kind of the value purchase, then the blueprint itself is $339. And again, it pays for not just the book, but also we've got 5 bonuses that are going with today's offer, and of course the support of both offices. Finally, and I'll get to Jan's question. Finally, if I'm going to tell you about bulletproofing, wouldn't it make sense for me to give you a bulletproof offer? Well, yeah, we stand behind this completely. All right, I stand behind this completely. 100% guarantee means that you have unlimited upside potential. All right, you have the unlimited possibilities. This is just like the structure of a married put, but you're bulletproof. It's like all this risk here that you're taking, buying the blueprint for $339 or buying the home study kit for $600. Hey, you know what? You could spend a lot more. You could have spent a lot more and be out that. Okay, but guess what? I'm not going to have you spend more. And if you don't think that the blueprint lives up to everything that I promise, well, then just send her back. Send her back, and we guarantee your satisfaction. Okay? And of course, if it does work for you, there's no limit to how well you can do. Okay? All radioactive trading products have a 100% money back guarantee, and that's how we've done this for the last 13 years. It's how we're going to do it for the next 13. Now I'll get to Jan's questions. We've got two. One is, can you set up a ratio call spread right at the beginning when you set up a married put? The answer to the question is maybe. Okay, it is possible sometimes. In fact, I've done that a number of times where I've bought the stock, bought a put, and done a ratio call spread right then. Other times, I'll buy the stock, buy the put, and wait because the ratio call spread isn't available at that time. Maybe it's just not possible to sell two upper strike calls and have it be more premium than the lower strike call costs. And so if I can't do it at a credit, it's not an income method, is it? Okay, and so I just won't do it. I'll leave it alone. But if I can do it at the get-go, I will do it at the get-go. And if I can't, what I'll do is I'll buy the stock and a put, wait for movement to manifest. If the stock goes down, I wouldn't be using income method 5. I'd use something else, perhaps income method 9, all right, or 12. And if the stock does move up or sideways, but the volatility increases, I may be able to get into an income method number 5. So this is the reason that we have 12 different methods. You know, the conditions of the market are not always favorable to do one, but it's always favorable to do at least one of the 12. Does that make sense? Okay. And a second question. Last Thursday, I ordered the blueprint. When can I expect it in the Netherlands? I'm not sure how to answer that one. I'm glad that you got it. So it's last Thursday you ordered it. Today is Thursday in the United States. It's the following Thursday in the United States. I don't know. If you don't get it within the next 3 or 4 days, would you give the office a buzz? Just send us an email at support@radioactivetrading.com. In the meantime, if you have some ideas for trading, don't just jump in. You're welcome. Okay, you're welcome. All right, cool. Other questions, folks? How do you like these covers? I'm kind of excited with them. They're cool. If you order the blueprint today, you get all the setups that ensure that you'll never lose more than 5% or less. Okay, you'll get the 12 income methods that will teach you how to take out premium or reduce your risk or do both. And you'll get the support of 2 offices, Colorado Springs office and the, I guess now it's the Monument office. I've moved to Monument, although I broadcast from Colorado Springs. And also the East Coast, the Delaware office. If you don't love the blueprints, just send her back. Call us up or send us an email, and we'll refund every penny. But that happens very seldom. It doesn't happen very often. We're pretty proud to have one of the lowest return rates in the industry, in our particular industry, of folks that do accept returns. You know, some options educators will not offer refunds on their products. I think that's, well, I don't know if that's entirely honest. I think the way that we do it is better for the public, and whatever's better for the public is better for options trading in general. So, what will it cost you not to have the blueprint? Think about that. Could it be, last year it cost you $500 not to have it, right? I mean, that's what some of you said. Some of you said that it was $500. Some of you said $5,000. Not having it, okay? And think about the fact that you're going to trade for more than another year. Maybe it'll be 10 years, okay? So, or longer, all right? So let's think about that, okay? And finally, I'll put up a wonderful testimonial from one of our radioactive trading clients. This was not solicited. I'm very pleased to report that we had a fellow that likes to invest in growth stocks, okay? And he says, "Dear Kurt, I received the blueprint and am a total believer in the methods. Thank you so much for sharing the idea of bulletproofing my stocks. in the last 6 months of trading, and this is I don't know, about a year ago, maybe more than a year ago. So he's talking about his previous 6 months. In the last 6 months of trading, even though 6 out of 10 growth stocks cratered, I was able to manage all of them with absolutely no loss. So out of the trades that he entered, 60% were losers, right? Okay, but he set himself up not to lose more than 5% in any of them, and in fact, because of the income methods, he countered how much he was ending up losing. So maybe he bought the stock and a put, the stock goes down a bit, but his income method offsets how much the stock went down, and he sells out of the stock and the put. He gets out without any loss. Well, the other 4, I'm sure he did fine, okay, but the 6 out of 10 that went down, he didn't get hurt by. In fact, he says, continuing, in some of them I even made money. Yeah, and I can relate. I did that with General Mills one time. I bought General Mills, bought a put option. I did an income method. General Mills went down 11%, so I made 0.7% profit. It doesn't sound sexy, but 0.7% profit beats the living snot out of a double-digit loss, doesn't it? Okay, and so that's what Sudhakar is happening here. Is having happen here. In some of them, he says, I even made money. I wish I had known about bulletproofing a year ago. Why, Sudhakar? Well, he mentioned another part of his letter that following a different program, and I won't mention the program because that would be professional, but following a different program, he got hurt. Okay. All right. What is most heartwarming for me, he says, is that almost all of my portfolio is bulletproofed. All right. Thank you again so much for the blueprint. And that was Sudhakar Rajalu, and I'm very thankful for that. Okay. All right. So, folks, this is the deal. If you go to radioactivetraining.com/iridium, that will have the best, we never do sales, but it has the best package of bonuses that we have available. Okay. Got a question here. Sharat says, does the initial setup always involve buying stock? Because it means a lot of capital needed to do that. Okay, Sharat, first of all, honesty. Were you one of the fellows that said he was doing very, very well, or one of the fellows that said that he needs some help on battling losing plays? I'm answering a question with a question, and then I'm going to give you an illustration. By the way, folks, if you want to check out now, the webinar is officially adjourned, but I do have something I'd like to share with Sharat. Need to get your answer there first, though, Sharat. Okay. Sharat says, does the initial setup always involve buying stock? Because it means using a lot of capital to do that. Okay. All right. I did my first radioactive trading play with $2,500 in capital. That's not a lot. $2,500 in capital is really not a lot. Okay, Sharat does not answer. Okay, well, I guess we checked out there. So, folks, the answer to the question, he left before I could give it, but the answer to the question is yes, we do use capital, and we do buy stock. Okay, we buy stock in each of these setups. Okay. Oh, we're back. Okay, very good. Well, tell you what. Here's what I'm going to do. Okay, I'm going to take us into the what do we call it? The trade simulator tool, and I'll give a very thorough answer to the question. Okay. Here we go. Resources, on the Resources tab, you can go down to the Trade Simulator tool. The Trade Simulator tool will show you the difference between leveraged plays and non-leveraged plays. Okay, so let's say that our target return is 66%. Okay, and our loss limit is 40%. Okay, and so what we're doing here is options plays. You understand? Okay, let's say that our probability of a loss is greater than half, and we're going to invest 100% of our plays. Now, before I do this, I've got a slide here prepared. I'm going to ask you, what do you think about this? Okay, you make a 66% return when you're right, but a 40% loss when you're wrong. Can you win this game? Oh, and you're actually wrong a little bit often, a little bit more often than you're right. Okay. Now this is a complete answer to Sharat's question. And it's a good question. It's a question that commonly gets asked. Okay. Can you win at this? If you make a 66% return when you're right, but a 40% loss when you're wrong, but you lose a little bit more often than you win, can you make money with this? And this is the equation that I showed you before with expectancy. We're going to find out something about expectancy. This is really exciting. It's really interesting, but it also, if you see the mathematics behind it, a light will go on. You'll say, wow, you just gave me the secret to succeeding. Okay. All right, let me go ahead and close this poll and share the results. Okay. So 33% said no, you can't win this. Being wrong more often than right, you're going to lose. Okay. And then 67% say, you can win, but it's unlikely because the 60% probability of a loss stacks the deck against you. Okay, let's see what actually happens when we run the simulation. If we were to run this simulation, we're bankrupt. Okay, so we're wrong a little bit more often than we're right, and we start out with $10,000. At one point, we might mistakenly believe we've got a winning system, and then because we're up to 27,000. But whenever it dips below 250, then it says we're bankrupt. Okay, well, let's run that again. Maybe that's just bad luck. We bankrupted ourselves after 54 trades. Okay, well, maybe let's try it again. Okay, we're bankrupt after 20 trades. Okay, let's do it again. All right, now we're bankrupt after 36 trades. Okay, now watch this. This is for Sharat. You ready? Instead of investing all of our capital in the play, we're going to only invest 10% of our capital. Now, even losing more often than we're winning, we're coming out with a winning record. Whoops. Okay, even when we lose more often than we win, even if we have a string of losers at the beginning and sporadic wins after that, we're still taking our $10,000 and we're making money. Isn't that interesting? So it wasn't that the having losers more often than winners stacks the deck against you. Okay, it's how much we bet when we do play. It's how much we bet when we do play. That's what the difference is. Now, what I'm going to do is we're going to go back to putting 100% of our money in, and then guess what? Target return is 6%, loss limit is 4%. That's pretty much the same thing, but instead of using options and keeping 10 times the amount of our capital out, which is what you would have to do to have this kind of result, we'll put 100% of our capital in, and we'll put it into stocks, and we'll protect ourselves with options, and this is the kind of setup that we get. Okay, the kind of setup that we get is a target return that's modest, a loss limit that's highly controlled, and even if we lose more often than we win, even if we have all of our money invested all the time, which is human nature, we're going to do very well. Here we are taking $10,000 and doubling it. Look at our big drawdown. The biggest drawdown is about 8.5%. Okay, kind of cool. So that's what this is about, Sharat. It's about using your capital the right way. If you use 100% of your capital in these leveraged trades, you're going to get hurt. But if you force yourself not to risk too much by putting your capital into mostly stock and then keeping your risk down to single-digit percents, then even modest gains are going to do great for you over time. Okay, so folks, that's it. That's our Dog and Pony Show today. I'm going to recommend that you pick up the blueprint today. And it's at RadioActiveTrading.com/iridium. And we'll see you out there. Happy trading, and bye for now.